wider deficits. For more on the rate outlook, let's bring in Subadra Rajappa, head of research at Societe Generale. Subadra, great to have you with us.
Thanks.
Do you agree with Jamie?
I look at it a lot, and I watch it very closely. I think it's a little too soon to call a debt crisis. I am concerned in general about the trajectory for debt and deficits in the U.S. as well as globally. I'd say the big difference is that in the U.S., it's, in some respects, since we're a reserve currency, we are able to get away with a higher level of debt and deficits in countries like, Japan or even in Europe. It's the dynamics are slightly different.
So let me ask you, what causes like escape velocity to sort of, take over? What has to happen? So far, we've not really experienced that in the U.S. So I can't go back historically and say I'd look at a certain period. I mean, 2022 comes to mind in the UK when we had kind of that Liz Truss moment when we saw, the bond investors start to worry about the trajectory for debt and deficits. What I'm paying attention to and what the CBO has pointed out is 2031, when the interest on the debt gets to be higher than the rate at which the country is growing. That's when you start worrying about the question of debt sustainability. We're still 5 years away from it, but it's something that's worthy of our attention.
So Jamie Dimon mentioned Paul Tudor Jones in an interview said our reliance here in the United States on the equity market is historic. And his concern is in terms of like market cap of the Wilshire 5000 to GDP is at levels we've never seen before. He thinks that could create a bond problem. And he laid it out pretty interestingly on top of what Jamie Dimon was saying. So it's hard in my mind to figure out how rates go lower, despite what the administration wants.
Yeah, I think you're absolutely right. I think it's very hard to see a scenario where rates are going to go lower. You're looking at much higher inflation, much higher sticky inflation for a longer period of time. There's no real willingness to address the debt problem. We're not going to be raising taxes anytime soon. And we have no easy way of growing out of our debt. So in that sort of context, I think I would expect interest rates to remain high, or at least in this kind of range for the foreseeable future.
Subadra, though, how about sovereign versus credit? And all we hear about also is a private credit dynamic. So which of these two, a fast money game, would you rather not own? I mean, where are you more concerned? Is it the sovereign debt market? I hear you talk about a timeline on sovereign, that various things could happen. This could take some time. Compare the credit world to the sovereign debt world.
So both of these are very, very large markets, right? So it really, you have to pick your credits and you have to pick your sovereigns. In the credit world, if you look at a lot of the credit spreads, IG or even some of the high yield names, I mean, you are starting to see some pressure in spreads. I mean, there's been a lot written about private credit. Again, it's hard to really think of that as a systemic concern that we should be concerned about in the credit markets. And, Jamie Dimon also pointed out that it's been a while since we had a credit-type event. Why? Because we've learned from the financial crisis to not, kind of repeat the mistakes of the past. But the question is whether there are new risks that we should be more aware of. And that's what I'd be paying more attention to.
Okay. So shorter term, Subadra, I read in the notes that the last time you were here, you were sounding the alarm on stagflation, and your concern about that is even greater today versus when you were here last. At the same time, equity markets are at record highs. So can we be in this environment where stagflation is a true concern, but the equity markets are at all-time highs?
That is a fantastic question. So you hit the nail on the head, because that's exactly what I'm grappling with, because there's definitely a disconnect between what you're seeing, the signals you're getting from the bond market and the signals that you're getting from the stock market. One of the markets is not giving you the right signal. If you look at it sort of independent of each other, it does feel like the equity market is looking at valuations and the bond market is looking at all the other risks, which is inflation, debt, the dollar, a whole bunch of other things that bond investors worry about. But there's definitely a disconnect between these two markets. I still think that stagflationary risks are rising, especially in an environment where oil prices are heading higher, not lower.
So the implication, I'm not trying to get you to make a stock market call, is that we are overvalued here. We're not pricing in the risk of stagflation in equities.
So I'm not an equity strategist, but I mean, I think that's, that definitely feels like there's a disconnect between what I'm seeing in the bond market and what I see in the stock market. Higher bond yields, sustained level of inflation, the Fed keeping policy on hold is going to have an impact on growth. And stagflation is kind of the scenario that the Fed is least prepared to deal with from a policy perspective. So that, again, is something that we should be concerned about. And we're looking at a scenario where there's not much the U.S. government can do on the fiscal side to stimulate the economy if we do have a meaningful downturn. So a lot of these confluence of factors has the bond market worried, but not the stock market.